Hello, everyone. Thank you for joining us for today's EEA Education Series webinar. Today, we will discuss the CME Group's journey to launch Ether Futures. Today's call is being recorded and will be available to all attendees soon after today's presentation. The Enterprise Ethereum Alliance is a member-driven standards organization whose charter is to develop open blockchain specifications that drive harmonization and interoperability for businesses and consumers worldwide. We welcome any and everyone to join and become a part of our global community. At this time, we are pleased to introduce our moderator, John Whelan.
Hi there, everybody, and welcome to the latest in the Enterprise Ethereum Alliance educational series. My name is John Whelan. I am the chairman of the board of the Enterprise Ethereum Alliance, and in my day job, I'm the director of digital investment banking, which includes digital assets at Banco Santander in Madrid. Today, I'm absolutely delighted to be joined by a colleague and fellow expert in the crypto and digital asset space, Payal Shah. Payal is the Director of Equity and Alternative Investment Products at the CME in London. CME, which was previously known as Chicago Mercantile Exchange, one of the birthplaces of the global exchange-traded derivatives markets going back many decades. Payal, welcome. Before we start, Payal, I think you're going to give us a presentation on the journey that the CME went through with regards to development of the Ether futures, which launched recently. And then we'll follow up by a short, I think, a Q&A. There'll be many questions coming from the audience via chat. But before we start, maybe you could give us a little bit of background about yourself and how you ended up with such a cool job at the intersection of finance and crypto.
Perfect. Thank you so much for that kind introduction, and thank you for the EEA for having me. I hope everyone is doing well. Thank you for joining, albeit virtually. So yeah, my role is Director of Equity and Alternative Index Products here at CME. And what my role entails is creating new and innovative products on key equity benchmarks, such as the S&P 500, the NASDAQ 100, the Russell, the Dow, and as well as in what we call alternative investments, such as crypto, Bitcoin, Ether. So my background really prior to CME was an equity index trader at Morgan Stanley, and then a little bit in ETFs at Credit Suisse and MSCI. And I guess, you know, what I love about this role, as you said, is that interconnectivity and connecting the insights from the equity world to this new and pioneering asset class that is crypto. So I'm really, really excited to talk to you today.
So with that, why don't you, I think you've got some slides to share, and by all means, lead the way. And following, once you're ready, I've already got a couple of questions in mind. It's such an interesting topic, and we will take it from there.
Perfect. Yeah. So today, as you mentioned, I thought I'd share just very briefly CME's journey into launching Ether futures. I can talk a little bit about the contract and the underlying index, maybe talk a little bit about the design choices that we made, touch a little on the success that we've seen in Bitcoin futures, institutional adoption maybe, and then, as you say, leave ample time for Q&A at the end. So let me just share my screen here to take you through. So hopefully you can all see that. So I have to say, as I said, I'm really excited to talk to you guys today. The interest in Ethereum technology has never been higher. I mean, as we talk to our clients, it's clear to see that there's a real upwelling of interest coming in part from DeFi, coming in part from layer 2 solutions, which are bringing scalability and efficiency, and in part from the 300 or so different projects that are currently in the works. And I think that there's a real excitement around Ether. And so with that backdrop, we launched the CME Ether futures contracts just over 6 weeks ago on the 8th of February. And what we're seeing is a real excitement for people to trade Ether. Of course, it's the second largest cryptocurrency by market cap and daily trading volumes on the spot exchanges. And it's something that our customers have long been demanding, especially since we launched Bitcoin over 3 years ago. Now, some of you, I'm sure, know CME really well, but let me just take a moment or two to introduce what futures are. So CME is the marketplace where buyers and sellers can come to manage risk, to access markets that they maybe otherwise couldn't, or to transfer risk between themselves via a futures contract. As the name suggests, a futures contract is a contract between two counterparties to the transaction where they agree a price at a future date and time for a specific commodity or underlying. At the maturity date, the contract could either physically settle, where they could deliver a physical commodity, or could settle financially, where the US dollar or the price performance associated with the underlying asset is transferred between the counterparties. As I said, Ether is our third crypto product, behind Bitcoin futures, which we launched in 2017, and Bitcoin options, which we launched in 2020. And it's our second token, and making this step really cements our commitment to cryptocurrency. The contract offers the benefits of trading on a regulated venue with deep liquidity, transparent price discovery, and gives folks the tools that they need to manage risk and volatility. So let's start by unpacking the contract a little. The Ether future contract has a 50 Ether multiplier, whereas the Bitcoin futures contract, which we launched back in 2017, has a 5 Bitcoin multiplier. So if we look at the spot markets, Ether is currently trading at about $1,700, whereas Bitcoin is at 56K. And when you take into account the multiplier, this is a much smaller contract, and that was largely driven by client validation. So one contract is 50 Ether, which gives a notional contract value of about $85,000 versus $280,000 notional value for the Bitcoin contract. It's fully cash settled in US dollars, and that design choice was in direct response to customer feedback and customer demand. And actually, it was also a lesson from Bitcoin futures. With a financially settled contract, you can get exposure to the underlying asset, but you don't need to handle anything like wallets, like custodians. You don't have to deal with the security concerns or insurance on your wallets. So it makes it really easy to access and does away with some of the barriers that you would find in traditional in the crypto spot markets. It trades nearly 24 hours a day from 5 p.m. Chicago time on Sunday to 4 p.m. Chicago time on Friday, with just a 1-hour daily break. The contract is offered in 6 consecutive monthly contracts and 2 nearest December contracts. So we're currently trading the March 21 contract all the way out to December 2022. Now, there are a few ways to use Ether futures, but the most basic way is as an access product. So if you want to invest in cryptocurrency, but you don't necessarily want to handle the digital asset itself. One of the key benefits of futures is that they are an efficient way to get Ether exposure. The fact that CME is a regulated venue makes it a lot easier for people. Our rules are very clear, they're very transparent, they're tried and they're tested. So for an institution looking to get involved in cryptocurrency, trading with an exchange that's highly regulated and one that they're already familiar with actually lowers some of the barriers which they're facing in other markets within crypto that don't necessarily have some of those regulatory frameworks. Also, as I mentioned, it's financially settled. It literally plugs and plays in the same way our other contracts do. So in some ways, it's no different trading crypto, Bitcoin or Ether, as trading CME S&P futures or our gold contract and settling in US dollars. Secondly, counterparty risk is mitigated. One of the biggest issues that exists in the crypto space, and what we hear time and time again from our clients, are issues arising with counterparty risk, pricing miscalculations, and illiquidity. One of the main reasons that folks come to CME in the first place is CME has a 180-year-old institution and has a long-standing tradition of bringing trusted solutions to the marketplace. So some of those counterparty risks that exist with other venues are mitigated when trading on CME. And I think it's for this reason we see clients are comfortable trading many months out in a way that ties up with their needs without having to worry about that counterparty risk. Also, when you look at the wider crypto market, events like hacking or price miscalculations happen in the wider market. And we see a lot of the flow coming to the CME product and participants taking benefit of the centrally cleared model that we have, where we have a clearing network, we have market risk controls, we have credit controls, we have all of these tools and safeguards in place that have been tried and tested and help people to feel comfortable. Thirdly, one of the central tenets is a contract with a robust underlying index. So we launched the futures contract in 2021, but together with our partners CF Benchmarks, we actually launched the Ether dollar reference rate back in May 2017. So the Ether future settles on the last Friday of every contract month to the Ether dollar reference rate, and that rate is regulated under European BMR. And something that we're extremely proud of. It gives the future and the underlying index that level of comfort and the idea of convergence to an index that really ties together the derivatives market and the cash market. So the Ether reference rate is a once-a-day reference rate of Ether in US dollar. It is published at 4 p.m. London time and is derived from executed transactions in the spot market from 5 constituent exchanges. And those exchanges are Bitstamp, Coinbase, Gemini, Itbit, and Kraken. Now, these 5 exchanges account for about 60% of the total ETH to USD volume. So a really good base to start with. Now, the executed trades in that 1 hour window, which is 3 to 4 p.m. London time, are taken, and they are partitioned into 12 5-minute samples. So you have all the trades that are coming in from the 5 exchanges within that calculation window, and that calculation window, that 1 hour, is cut up into 12 5-minute samples. For each sample, the volume-weighted median price is taken, and then the straight line average of those 12 samples is calculated to give the daily Ether price. I'd say we really did our homework with the Ether reference rate, and that's really what made launching the futures around it that little bit easier. The reference rates were designed where the methodology was transparent. It could be observable. It would be discrete. It has an oversight committee. It has an index administrator, a calculation agent, and most importantly, it's demonstrated that it can be reliable in times of high market volatility. So diving a little bit deeper, the use of medians really reduces the effect of any outlier prices from any exchange. The volume-weighted median filters out multiple small trades that may otherwise dominate. The use of 12 partitions means that influencing the rate would require multiple trades on multiple partitions on multiple exchanges over an extended period of time, which would obviously prove to be costly. And of course, there is no over-reliance on any one exchange. Actually, further during our design process, we saw that there were trading frictions and differing KYC and AML practices at the different spot exchanges had an impact on the prevailing price. As such, the Ether dollar reference rate only includes executed transactions in the ETH USD pair. So we don't use alternative currency pairs, we don't apply currency conversions, nor do we use stable coins or USDT in the transaction. So as I say, we're in week 7 of Ether futures, having launched them just last month on the 8th of February. They're off to a great start. Average trading volume is around 725 Ether contracts. So as I said, with one contract representing 50 Ether, that's an average daily volume of over 36,000 Ether equivalent. The peak of the blue line there in mid-February shows 2,092 contracts traded in a single day, which is nearly 105,000 Ether equivalent, or 160 million US dollar. The white line represents open interest, or the number of contracts that are held overnight, and day by day OI is growing. It's currently just over 1,300 contracts. So we're off to a really good start. We've got a growing order book, we're developing liquidity, we've seen some block trades come in, and yeah, we're really quite happy with the progress so far. Over 430 unique clients have traded so far. And what's interesting is that about 35% of that volume is actually traded outside US hours. So in terms of use cases, we have folks that are trading, that are staking or accumulating ETH positions, or having ETH positions from ICOs or fundraisings that they need to manage without maybe offsetting that underlying position. Similar to the miner use case in Bitcoin, it protects from some price movements if you're long the underlying and you sell the future. Or if you have other investments in the marketplace, you can use futures as a way to counterbalance some of the potential swings in price without having to liquidate the asset. And that's an enormous benefit of the futures market. The other thing I'd say, as we look at some of the use case, is the continued interest from institutionals and institutional adoption of crypto. And we're on top of the more crypto native use cases around mining or staking, or figuring out how to hedge yourself on a transactional basis of crypto versus fiat. We now have numerous market makers who are looking to allocate and invest in cryptocurrency, or that are deploying strategies that they've used in traditional asset classes, where they are maybe looking to arb between various crypto products in the marketplace, or use futures, or in some of the borrowing and lending businesses that we're starting to see flourish as well. So let me just pivot slightly to Bitcoin futures, if I may. The launch of Bitcoin futures has been a success story for the exchange. As we look over 2020, we see that the marketplace has continued to grow. Volumes have continued to grow. Open interest has continued to grow. And we view ourselves as the leader for derivatives in this space. So we launched Bitcoin futures in 2017. And if you just look at what happened in January, there was huge institutional adoption. Just in January alone, we traded 17,500 futures contracts per day in Bitcoin, which made it the best month ever. We have a 5 Bitcoin multiplier, so that's the equivalent to 88,000 Bitcoin traded every day. And that makes it one of the largest US-based risk transfer platforms for Bitcoin. Open interest in Bitcoin futures has also been growing steadily, and the average OI for Q4 2020 was just over 11,500 contracts. We continue to see institutional investors coming into the contract, and that's demonstrated by the number of large open interest holders and how that continues to grow. So large open interest holders are those holders or those traders who hold more than 25 Bitcoin contracts. And of course, each contract is 25, each contract is 25 Bitcoin. So large open interest holders peaked at 110 such holders in December. And to put that into context, if 25 Bitcoin futures is equivalent to 125 equivalent Bitcoin. So in today's money, those clients are holding at least $7.2 million of notional Bitcoin equivalent. Now that's huge. Also, what we're seeing is the number of unique accounts that have traded our Bitcoin futures grow steadily. And we're currently over 7,000 unique clients trading. The appeal is both from a domestic US perspective as well as international, with 50% of volume for Bitcoin coming in before the US market open. So really, all of this is to say that we're seeing growing ADV, growing OI, growing large open interest holders, and all of these signs point to a robust futures market, and we're hoping to build the same for Ether. So I'll pause there, and probably a good time to maybe take some questions.
Thanks a million, Payal. Very interesting indeed. And I say that as an ex-floor trader from the Chicago Board Options Exchange going back 20 years ago. So this language is something that I remember well and recollect very well and fondly. Got a ton of questions, actually. Some of which actually have come by email, and there's a couple that have popped up in the Q&A, and I'll try and maybe encapsulate the general themes throughout the set of questions. Let's start with kind of something that's basic, and it's really about the CME itself. How did an exchange that's known for I would say traditional derivatives on everything from equity indices, foreign exchange, interest rates, through different commodities, crude oil, gold, and corn, decide to get into crypto? What was the thinking and the decision making, and maybe the length of time it took for management and the discussions in the different committees to understand the opportunity and then to make the decision to move forward? What was the get into crypto decision process like for CME?
Yeah, sure. It's a great question. So I guess it comes down to two things, really. It's innovation and it's customer demand. So CME has a long history of innovation. We started off as a butter and eggs exchange back on the streets of Chicago, nearly 200 years ago. And over that time, we've constantly innovated. We introduced the first futures contract on corn way back when. And since then, we've introduced financial contracts in the 1970s, FX contracts. And now we offer derivatives, so futures and options on futures, as well as cleared OTC products in the 6 asset classes. So everything covering fixed income, equities, FX you mentioned, metals, ags, energy, and also cryptocurrency, which is everyone's favorite topic joining us here. So it was that long history of innovation, and the second part really is customer demand. So in direct response to customer demand, in talking to our clients over the past 4 years, we've seen that those clients had an increased need for risk management. They needed a trusted risk management tool, and it was clear that they needed transparent price discovery. So initially, as I look back, our clients initially had a need to access Bitcoin in a trusted and regulated way on a regulated exchange, on a regulated marketplace. And so we availed the Bitcoin reference rate all the way back in 2016, and then launched our dollar-denominated, financially settled Bitcoin contract in 2017. So really, the journey, although we launched Bitcoin futures in 2017, the journey started way back in 2015, really availing those reference rates and then building the future. And that's kind of the story that we've taken, or the approach that we've taken with Ether. Again, launching those Ether reference rates and then following up with the futures. And that's something that's worked really well, and in a way that has really helped serve the needs of our clients.
Well, Bitcoin and other cryptocurrencies are a very new phenomenon. Bitcoin itself has only been around since 2009. Are you and your colleagues surprised by how quickly Bitcoin and the other digital assets have become kind of an asset class of their own? Is that something that you're surprised by, the speed at which the cryptocurrency space has grown into an asset class that's now being discussed, on the different business, cable TV news shows, over coffee, among friends? are you surprised at how quickly it's become an asset class?
Yeah, I mean, that's an interesting one. It's absolutely everywhere, isn't it? And actually, when I think over 2020, I think it will be remembered for so many things. But to me, it's probably the year that institutional participation in crypto really accelerated. And I think the reasons for that are probably threefold. So I think to start, there's that global adoption or that growing interest in blockchain technology that's really coming to the fore. 2020 ushered in important improvements in crypto market structure. There was growing involvement from the spot exchanges, from the custodians. There was enhanced security. Regulations were starting to come into play, and we saw even with ETH the layer 2 improvements that really helped underpin Ether and all the projects that we're seeing in the market right now. So secondly, I think more institutions are warming up to the idea of crypto, and that increase in demand, probably due to the current macro environment, is now more at the forefront. And I guess thirdly, it's institutions have started to include crypto in their portfolios. And because of that, they need a trusted venue and a trusted way to manage risk. So I think it's for all of those reasons that it certainly needs to be an asset class of its own. Whether you're a native holder of the underlying crypto and you need a way to manage that risk, or you're new or you're managing or allocating to cryptocurrency. So it certainly needs to be an asset class to itself. In terms of the growth that we're seeing, I think, that growth level over the past 4 years has been phenomenal. And now with the 3 products that we have in play, so the 3 products within the crypto asset class, we can see people are starting to trade or allocate to Bitcoin. They can allocate to Ether. They can trade against each other. And now we're starting to see that portfolio effect really take place around crypto. So that's really exciting as well.
Interesting. I hadn't thought of that. I guess the pairs trade of long one future, short the other is always possible. Not picking a direction, of course. So, the spot cryptocurrency markets have been around since, let's say, 2010, more or less, 2011, getting progressively more liquid over the years. Derivatives on top. Still relatively new, of course, with the CME Bitcoin futures launching in December of 2017. Do you have a particular perspective on the evolution of the crypto derivative space? As we know, CME is not the only derivatives or let's say mainstream exchange that is offering crypto derivatives. But what's your perspective on the evolution of the crypto derivative space over the last 3 years, and maybe you can project a little bit forward as well? How do you see that evolution progressing, understanding, of course, that nothing is certain?
Yeah, sure. So I guess when we look at CME's journey into cryptocurrency, as you said, we launched Bitcoin futures in December 2017, so just over 3 years ago. But that journey started way back when we launched the Bitcoin reference rate in 2016. And we're hearing from our customers that they really needed a need for price transparency as they themselves were getting into the space, and they started getting involved with all these financial products that they needed for risk management. And I think from our perspective, that's what really drove our curiosity. And it was trying to understand what's our role in the marketplace. What role do we need to play for our customers and for the market? And as I said, it was at that point really that we introduced the Bitcoin reference rate in 2016, and then came futures. And so what's evolved is also who's trading CME Bitcoin or who's trading CME Ether. And we're seeing so many different personas coming together. with different reasons for why people are trading. You know, we have the hedgers coming in, we have the miners, we have those firms who have accumulated open market positions through spot markets. We have people who are using futures because it's on a regulated exchange and they want to use it as an access point in lieu of the spot market, perhaps. And then you've got the other side, you've got the speculators who are looking to trade or to deploy strategies around price movements, or those that are taking a longer term view. So it's becoming this melting pot, if you like, of all of these different personas that are coming together. And it's exactly that that makes the market more efficient. And I think what's also changed over the kind of the last 4 years is that definition of the institutional investor. That's really involving. You know, now with the advent of crypto-only customers, or crypto-only trading companies, or crypto-only hedge funds, or crypto lending platforms, you see this new and expanded consumer base. And I think, you know, what's evolving is that interest in blockchain technology. And I guess what I mean by that is, if you see, you know, some of the stories in the media, as you say, about some of the corporations that are accepting Bitcoin as payment, or some of the DeFi projects that are currently in the works, they all have a real need to manage some of the assets and liabilities on the balance sheet. So, for example, if you're accepting or utilizing digital asset in a transactional capacity, but you're still plugged into fiat, a fiat-based economy, then you have a need to manage the risk as you transpose from digital into fiat, or vice versa, to engage with customers, or to pay vendors, or to pay employees, you know, make investments, you know, pretty much all the things that you would do for, you know, a fully operational business. So it's that evolvement that will continue to drive product from our perspective, and it's great to be, you know, in that mix.
I was scrolling through Twitter shortly before this particular education webinar, and no surprise, but Elon Musk was announcing that they were planning to not only accept Bitcoin for car purchases from Tesla, but the plan was to actually hold the Bitcoin on the books and not convert it to fiat. And I'm guessing an appropriate hedging strategy would be to have a relationship with some exchange like the CME that can offer the hedging capability through futures, so that they can essentially lock in direction or hedge off directional exposure, while allowing them to keep the Bitcoin on the books if that's what they so choose, and not have to directly convert to fiat. And that's obviously one of the very straightforward use cases. The other being, of course, naturally, as miners accumulate Bitcoin, they want to be able to lock in certain prices and profits so they can pay for their normal expenses, which would probably be in dollars or yuan, or wherever their operations are located, which of course is why futures were invented in the first place at your now partner, I guess, or Chicago Board of Chicago Board of Trade, going back a couple of hundred years. Interesting, the world is coming full circle here. A question. So in the case of both your Bitcoin futures and Ether futures, you decided to first introduce reference rates and then launch futures in those. And why did you take that approach? And I've actually got a couple of more detailed questions here about the construction of reference rates, which might be a little bit more technical. It sounds to me like you're an expert on these topics, but maybe describe why you would start with reference rates before introducing derivatives.
Sure. I mean, primarily that design choice was in response to customer feedback and customer demand. So when we think back to 2015, 2016, the price divergence, if we think about Bitcoin, you know, at that time, Bitcoin was the dominant cryptocurrency. But if you think about price divergence across all the various venues and spot exchanges, it was so wild, you know, over $1,000 price differences intraday within the same exchange, let alone, you know, when you're talking globally. So there was a real need for price discovery and price transparency. And so the crypto reference rates were built for this transparency and for that consistency. You know, something just like the S&P that's published every day at the same time using the same, you know, transparent methodology. It was trying to apply the lessons, you know, right at the beginning of our conversation. You asked, you know, what drives my passion for this role, and it's applying those lessons that we have in equities to crypto. So in the same way that the S&P is built on a robust underlying index, it's trying to use those same techniques to crypto. So trying to look at the market, to understand where is the trading coming from, which are the constituent exchanges that we should use, how should we build that methodology so that it's resistant to manipulation, how can we ensure that the price is reputable. And so really that's, you know, it was the creation of the BRR that was our first step, the Bitcoin reference rate, and then came the future. And we followed exactly the same process with Ether. And I guess the second thing is convergence to an index. You know, that's a really key idea. As I say, you know, in the same way the S&P settles to the S&P index, the Ether future will settle to the Ether reference rate. And so even though it's calculated every day, including weekends, our futures actually expire on the last Friday of each contract month. So at that point, because they're financially settled, on that last Friday of the contract month, it's a point of convergence, and the value of the future will match the value of the underlying spot exchanges. So it's this convergence, and that feature, I guess, it's really powerful. It helps keep the market aligned and encourages participants to trade away any arb that separate the two markets. And that's what leads to the efficiency of really transparent price discovery markets. You know, for Bitcoin, we're still in the early days. Yeah, it's been around for 10 years, but really we're right in the early days. But if you look at markets like the S&P or the NASDAQ, you see highly efficient correlated markets. And as more participants start trading both the spot and the derivatives, I think we'll start to see that highly interrelated ecosystem. And really, that was one of the central tenets of building to an index. So having the index, allowing that price discovery to happen in the cash markets and in derivatives.
Just a question about the construction of an index, and it's not specific necessarily to the crypto indices that you've built. Maybe it's a little bit broader, but there's a selection process you need to go through with regards to picking, you know, price and liquidity sources and these things. Roughly, what does a methodology of a selection process look like? What are the key things you look at? There's probably a huge variety of different potential sources of data. You obviously have to have a rigorous filtering mechanism. What does that kind of look like in general?
Yeah, sure. So for crypto, together with our partners CF Benchmarks, we put together exactly that methodology. So not just a methodology about calculating the rates, which is kind of, you know, what I talked about a little bit earlier in terms of that 1 hour segment, you know, and picking, well, what hour period should we take? So we picked 3 to 4 p.m. London because it was the most liquid hour for Bitcoin. So, you know, the methodology, the reference rate methodology talks about what hours shall we use, what's the most liquid, how do we ensure that it's resistant to manipulation by having that 1 hour window cut into those different partitions. But in addition to that, or alongside that, we also put together a constituent exchange methodology. So really that looks at the 400 or so different spot exchanges that exist and how to whittle those down into the ones that have meaningful price discovery, that do away with some of the more the trading practices that do away with wash trading, or some of those market manipulations, that they have good AML and KYC processes in place, that they're open to working with a regulator. So it's really a list of criteria that we established as an oversight committee that we can then apply, making sure that the number of transactions that they provide into a calculation is enough. There's no point in including an exchange that does one Bitcoin transaction every day. Even though the price is right, you need that velocity of trading to ensure that it's a good price. So it's all of these things that really went into the development of a methodology around crypto exchanges and which ones could be included into the Bitcoin reference rate or the Ether reference rate.
Okay. Maybe let's get a bit more specific about the Ether futures themselves. Just launched 6 weeks ago in February. I remember the announcement. I think there was lots of, on crypto Twitter, if you follow it, lots of applause and pats on the back. Why now? What was the, as soon as you launched Bitcoin futures, I think there had been talk and chatter that perhaps Ether futures were coming. What was the particular driver for February 2021?
Oh, that's an easy one. 100% client demand, 100%. Talking to our clients, Ether was always second on their wish list. It's the second largest token by market cap. We've talked about that acceleration in Ether and in DeFi, but I guess the why now is that right now there's a real interest, and what has really accelerated people's curiosity in Ether now is when you consider the backdrop of DeFi, of that growing appreciation for it, that enthusiasm, the adoption around the Ethereum network, and it's the momentum that it's providing to the space. And so as you look at the number of projects coming online, there's a certain amount of excitement of how people can use these to improve traditional finance processes. And there's a real need for Ether and the Ethereum network, which brings with it real risk management needs. So it's that increase in demand from the users, from the use cases, that again, that melting pot of everything coming into play. We already had the reference rate being generated from 2017. So we wanted to give the reference rate enough time to really ground itself and have an appreciation and a robust track record. So it wasn't going to be launch the reference rate and within a week launch the future. We always knew that we would give it some bandwidth. But I think 2021, right now, it really is that explosion in DeFi in those projects and that real risk management need that so many of our clients are talking about.
So I'm guessing that the bulk of CME's clients are financial institutions of some shape or form, perhaps hedge funds, family offices, different asset managers, different proprietary trading shops or mining companies, which, are kind of like financial institutions, non-bank financial institutions themselves. But there's also been, I think, quite a lot of discussion in what I would characterize as being mainstream financial institutions about their attitudes, particularly in perhaps participation in Bitcoin, Ethereum, and other digital assets as a whole. Why do you think the mainstreaming of interest is occurring?
Yeah, that's a really interesting one. And you can't ignore the growing interest that has come from banks, from asset managers, from other firms, in all of those recent announcements. And the conversation has really changed. That I think that's what I'm noticing the most, that the conversation has changed. Back in 2017, the conversations were more around what is Bitcoin, what is crypto, what is Ether? Is it right for me? Is it right for my investors? Whereas right now, that conversation has changed. As people have got more comfortable with the technology, with the returns, with the uncorrelated risks that it offers, the conversation has evolved, as I say, to how should I allocate, not what is Bitcoin, and what is Ether. So that's really interesting, and that's really reflected in the numbers. So, in January 21, it was our best month ever since launch for Bitcoin futures, where we did just about 17,500 Bitcoin futures per day. So that's 90,000 Bitcoin equivalent. And year to date, end of Feb 2021, we're averaging for Bitcoin futures 15,500 futures a day. And so that's open. That's up 76% year on year versus 2019 full year. And so that growth is phenomenal in Bitcoin. We've got over 7,000 unique accounts trading Bitcoin, and 3,000 of them were in fact added in 2020. So it's the whole shift of both native users, institutional adoption, and participation in Bitcoin and Ethereum, that mainstream adoption. It's all coming together. And I think what's clear right now is that one has to have an opinion on crypto. It's not enough, to sit on the sidelines. It's not enough to not have an opinion. One must have to have an opinion. It's okay that it's not right for their network or their clients, but it really is, where is that demand coming from? And that's really what we've seen.
So I think most of our listeners and most people around the crypto space understand the key differences between Bitcoin and Ethereum. Some of the underlying technology is quite similar. Some of the cryptography is similar. The consensus mechanisms are similar, but there are two key differences in the networks themselves. Number one, Bitcoin was designed as a payment system, peer-to-peer electronic cash, famous from the original Satoshi white paper launched in 2009. Whereas the Ethereum token, it can be used for payments, but it's not its primary purpose. Its primary purpose, in addition to providing an incentive mechanism, an anti-spam mechanism in the network, is actually to pay for gas, the computational horsepower that is required to process state updates, which are driven by programmatically by the smart contracts. Now, we know that, and it's kind of obvious. Do you think, or do you anticipate that your clients that are trading Bitcoin and Ether futures are fully aware of the subtle differences between the actual underlying tokens and their design characteristics? Or do you think they've been able to abstract themselves perhaps up a layer and treat Bitcoin and Ether perhaps as an asset class together? Or do they see Ethereum futures as being something special that they must have access to?
Yeah, I think it's different for different users. Certainly when we were designing the product, it was something that we were definitely aware of. So that gas cost, the transaction cost, of designing the futures contract and designing the underlying reference rate. So it's something that we definitely thought about. But in terms of our users, I think it's the different users have a different appreciation. So for the ones that wish to speculate on price, the beauty of futures in one way is not necessarily having to get into the granularity of understanding gas and what for Ether, what the project pipeline looks like. When is the next hard fork coming? When is the next upgrade? What does that mean? It's really the future is a plug and play. So if you're trading S&P or if you're trading Ether, it's the same thing. You don't have to be connected to the wallets, or you don't have to have necessarily that appreciation for gas costs. But what I will say is that as a function of efficient markets, that slowly becomes factored into the
Hi there. It appears that we may just have lost Payal momentarily from our Zoom connection. Happens from time to time. And I see that Payal is trying to reconnect. Let's give her a minute or two. Hi there, Payal, you're back.
Was I boring you? I was boring Zoom.
You dropped out from Zoom for like 30 seconds or so. So I think we missed the last 30 seconds of your comments.
Sure. So I was, yeah, for gas, you know, it's something that we certainly looked at in the design process. And I think it's one of the features of a futures contract where you don't necessarily have to understand all the complexities of gas costs or transaction costs or, you know, the development pipeline. But what's interesting and what makes for efficient markets is slowly enough, all of those things start being reflected in the price. And so, you know, you won't have, you know, come 15, 20 years, you won't have these wild upswings, and, you know, that will be reflected in the volatility. So I think certainly you know, a different level of appreciation for the underlying network, if that's fair to say, dependent on the different users of the contract and of futures and of derivatives overall.
So from CME's point of view, Ether futures are, in some respects, just another product for your clients, which have many varied needs as far as hedging and speculation and planning for the future goes. But with any product, you know, whether it's a car, whether it's a financial service being offered by a bank, or whether it's a derivative being offered by an exchange, there is an adoption process, there's a marketing process, there's a communication process, etc. How does CME anticipate growing institutional adoption of your Ether futures product?
I mean, it was the same way as we did with Bitcoin. It's a lot of education. And as I say, you know, to begin with, it was mostly educational and less promotional. So really getting people comfortable, not just our clients, our regulators as well. You know, what is Bitcoin? What does this mean for the market? Where is it going? What is blockchain technology? So that education piece, I think, is key. And I think that is what will help grow these markets, the educational aspect. Then comes the promotion, you know, the access. So there are so many different access points that one can use, you know, be it the spot markets, be it the unregulated futures, be it our futures on the regulated side. And really each one has its own unique advantages or benefits dependent on the client use case. So for some users, regulated futures will be right for them. For others, spot markets will be right for them, or they may be able to access both venues, whereas in some mandates it'll only be one. So the second step, I guess, is that education on the ecosystem, what's out there, what's available, what suits the client's needs, and that will really drive development in terms of what we do from here. So, you know, right now, Bitcoin and Ether is certainly keeping us busy, but in terms of, you know, what comes next, it's really that design loop or that feedback loop to say, well, what should we be introducing that will help users use this contract? You know, we offer the contract, you know, 5 days a week at the moment, you know, with the spot markets open 7 days. So already that there's a slight disjoint between the futures and the spot. So really, where do we go from here? And that's something that I would urge, your members and users of crypto to really reach out to us and share their feedback so that we can build from that.
So interestingly enough, on the Bitcoin side, you don't just offer the futures, but you also offer options on top. Some of our viewers may not realize that in order to offer options, you also have to offer probably a future as well, simply because the market makers in the options need a way to hedge their directional exposure to the positions that they accumulate through the process of making markets. It's called delta hedging. So I guess an ancillary question would be, is there a threshold level of volume that you were waiting for in the Bitcoin futures product market before triggering the step to enabling options? And I'm guessing there's obviously maybe a similar thought process going on mentally. Whether or not there's sufficient demand from the clients is a separate question, but at some point you need a sufficient level of volume in the underlying future to make the options market viable. How long did that actually take with Bitcoin to occur? And does it appear that we're on a similar trajectory from a volume point of view, from what you can tell 6 weeks in, or is it too early to tell?
Yeah, I mean, for Ether, it's probably a little bit too early to tell right now. But if I can take you through Bitcoin, just the key milestones. So we launched Bitcoin futures contracts in December 2017, and then followed up with options on Bitcoin futures in January of 2020. So it was, we gave the futures the time and space that they needed to build that open interest, to build that volatility, to build that the open interest, to build the volume, to build the large open interest positions that I spoke about, and really, to have all of those things within the contract to enable options. And options, some of our clients were asking for options a lot sooner, and it really speaks to a different use case in some scenarios where futures may be the better choice for some users, whereas options might allow a different access point. So it's really having that complementary suite of crypto products, from the reference rates to futures to options on futures, that we wanted to go for with Bitcoin. And we're hoping that Ether will follow a similar trajectory in terms of the way that it's trading, the number of users that are in the contract, the way that open interest is starting to grow. But really, 6 weeks in, it's far too early. But we're certainly seeing a few of the similarities in terms of users and use cases. So yeah, we're watching the space.
Makes sense. So Payal, we're right on time. I would think, looking at the clock, maybe 30 seconds left. Do you have a final comment before I close out? Is there anything that I missed? Is there anything obvious that the Ethereum community needs to know, or the broader community?
Sure. I mean, the main ask, I guess, would just be that feedback loop. That is really what we're here for. Finding solutions for risk management, regardless of price. We're price agnostic. So if your members, if they're keen to know more about the underlying reference rates, if they're keen to know more about the futures or the options, then really to get in touch, or if there's anything that, those ideas, if there was just this, or wouldn't it be cool if there was that? So it's all of those things that we would love to hear. So please feel free to get in touch with either myself. We'll share the slides just after the presentation, so the contact details will be there. So yeah, please feel free to get in touch.
Perfect. And with that, I want to say an enormous thank you to Payal Shah, Director of Equity and Alternative Index Products at the CME in London. Payal, it's pretty clear. Two things are pretty clear, actually. Number one, you have an enormous enthusiasm for this work in this space. And number two, you just might have one of the coolest jobs in finance. Thank you very much, everybody.
An absolute pleasure. Thank you.
Likewise.
Thank you, Payal. Thank you, John, for both joining us today. Please feel free to place your social media handle in the chat so all our attendees can follow your work. If you're interested in the leading blockchain work going on within the EEA, please send an email to membership@entethalliance.org. Again, that's membership@entethalliance.org. Thank you. This concludes today's EEA Education Series webinar.